Well, thanks for joining us today, Michael. This is Michael Reeder. He's managing partner at Reeder CPA Group, which has a niche of working with franchisors, franchisees. I've referred many of my clients to him to help them set up their business, to help them manage and minimize their taxation of their business once they're in business, and even to help them vet the financial possibilities and build out 3 and 5 year projections. So thank you for joining us today. And today I
Great to be
wanted
here, Jane.
Good to see you, by the way. And I wanted you to talk about this little known section of the tax code called Section 179. And I didn't know much about this. Years ago, I was showing vending machine businesses to a guy who made a lot of money. And it was in, July or August. And he was like in a big rush to get this done before year end because he had had a gigantic capital gain that year. So tell our audience a little bit about 179 and how one could use it when buying a business.
Yeah, absolutely. So the umbrella term is accelerated depreciation, right? And so accelerated depreciation allows you to make a capital expenditure into a in a fixed asset or fixed assets, and these fixed assets that normally under a regular depreciation life, 5, 7, 15 years, if they qualify for accelerated depreciation, the two terms are Section 179 depreciation and then also bonus depreciation. This allows you to take to write off the entire amount of the asset in the year of purchase. And so the difference between Section 179 depreciation and bonus depreciation, one of the main differences is that for Section 179 depreciation, you can write off the asset to the extent of profit. You can write it off in full to the extent of profit. So if you have a $300,000 profit, and then before depreciation, and then you invest in a $300,000 piece of equipment, you can Section 179 it, and you can wipe out the entire $300,000 of profit at the federal level. Now, again, depending on states, some states have, they add back accelerated depreciation. So you might, so it's not, it depends on what state you're in. And then bonus depreciation, on the other hand, let's say you're a startup business, right? So, if you're investing in a bunch of vending machines in October of year one, right? So they're not going to cash flow in time by the end of the year, but they're going to qualify for bonus depreciation, which means, even though you're going to have a loss, it's going to further increase the loss, right? It's going to further drive the red, right? And then so if you're making $400,000 or $500,000 or more on a W-2, then that loss is going to flow through to your W-2 income on your personal tax return and wipe out a huge chunk of it, if not all of it. Again, like depending on, how big the investment in the fixed assets is. And so bonus depreciation used to be 100%. In 2023 it was 80% of the investment, and now here in 24, as we leave this recording, we're in end of May of 24 right now as we do this recording, it's 60% right now. And there's some rumblings in Congress that they're going to make the 100% retroactive. They're going to bring that back for 23 and 24. We'll have to wait and see, but it's still, even here in 2024, 60%, it's still significant, and the remaining 40% would get capitalized and depreciated over the remaining 5 or 7 years. But that is, that's a huge, and especially let's say that you were to invest in a business that's very fixed asset intensive, and you were to do it as an LLC, and you were to heavily finance it, let's say with an SBA loan, right? Then, you're going to only come out of pocket, let's just say maybe 10 or 20% on a down payment. If it's an emerging brand, you might have to go a little bit higher than 20%. But then the remaining 80 or 75% is going to get financed by a third party debt. But then you're going to be able to, still, even though you didn't pay cash for the entire investment, you financed a portion of it, the majority of it, you're still going to benefit from that depreciation, from that bonus depreciation. It's going to create a loss, and that loss is going to flow through to your personal return where there's other high income, and that can be a massive tax savings.
Yeah. So it's hugely beneficial to a semi-absentee owner who has a very high salary on his day job and is investing in a business for, additional side money and to build up an additional revenue stream. So, yeah.
Yeah, I like to think about it I like to think about it as like the path, because you don't want to invest in a business. This is common sense. I'll just say it. You don't want to just invest in a business for the write-offs, right? You want to invest in a business because it's going to become a cash flowing machine. But
Right.
on the path to it becoming a cash flowing machine, you can take advantage of like maximum tax losses to help you save money in taxes over your W-2. So it's like having the best of both worlds.
Yeah. Well, great. Well, thank you for explaining that to us, and it's good to see you. And that's it for today's lesson on how to minimize your taxes and maximize your profits. Thanks a lot.